All right, everyone. Welcome to week 5. So today is the last lecture before the midterm. So midterm, I'll talk about the logistics first today, and then we'll talk about the quiz from last week and the ungraded homework set, and then today's topic on purchasing power parity. So let's go over the midterm logistics, which is probably what's on everybody's mind. So several of you already asked me through email what's going to be covered. Everything up to today, end of today, is fair game. So today's topic is just an extension of last week. So last week we talked about short run, long run analysis. So this week we're going to be more focused on what we mean by long run. So that's basically what we're doing. We're defining what long run means, and then trying to basically give you a framework to think about long run forecasts of the spot exchange rate. Given you have if you're a central banker, you have to think about monetary policy. You can actually impact long-run changes of the spot exchange rate through changes in money supply. And it's a very specific kind of change we'll discuss later on today. So 8 to 9 questions, essay format. So it's going to be very, very similar to the way the ungraded homework problem sets are written. I'll give you a description of the context, and your job is basically to interpret the context in the framework that's presented to you in the past 5 weeks. All right, so remember, we talked about UIP, money markets, and you talked about various parameters such as Y, interest rates, money supply. These things are always talked about in the business news. So if you bring up the Wall Street Journal, you bring up The Economist, a good practice would be looking at the news and trying to predict or understand what the article is talking about in whatever we presented to you up to week 5. Okay, so that's kind of my advice. So number 1, go over the ungraded problem sets. And number 2, read through the latest news within the last 1 or 2 years. Think about monetary policy announcements in the context of our framework that's presented to you. And yeah, think about how to make predictions on the spot exchange rate, which direction it should go, depending on what's being announced by the central bank, for example, what's being announced by the government of COVID policy. How does that impact exchange rates? How does the war in Ukraine impact exchange rates? These are all things you should all be now thinking about, right? You have a framework to work through the logic. All right, so the exam is written in such a way that you should be able to finish within an hour, to be honest. But every year I get complaints that you don't have enough time, so I will give you the full 2 hour and 50 minutes. So next week, you just show up to class, just like final exam before the pandemic. You bring your ID. I will have TAs come in, check your ID, and you just submit your exam when you're done. I don't expect most of you to require the full 2 hour and 50 minutes, but my advice, again, make sure you look over the material before taking the exam. Otherwise, it could take you up to 3 hours to finish. All right. Despite being open book, open notes, you have to work alone. That means no talking to each other, no texting, no computers, just like what we had before the pandemic. And you must sign the academic honesty pledge, otherwise the exam won't be graded. So there's going to be a page where you have to read and then say, I agree, basically, sign your name. And bring your IDs. The TA, I have 2 TAs, so the afternoon class will have a TA that's going to check IDs. Also, the noon class will also have a separate TA to check IDs. Calculator is okay. So if you have your Texas Instruments, whatever model, that's perfectly fine. As long as you have, I don't know what kind of calculators they have today. Are they wireless? If they're wireless, you better have it turned off. Okay. The TA's job again is just to proctor, so he or she will be walking through class, making sure nobody's texting each other or whatever. Okay, so if you want your exam to potentially be regraded, maybe the TA made a mistake when grading the exam, make sure you write your exam in black or blue ink. All right. Otherwise, pencil, you could change your answer after it's graded. I don't know. But if you want a regrade, make sure you write in black or blue ink. All right, so that's basically the logistics. So just treat it as in-class exam, pre-pandemic. You come to class, you bring your IDs, you sit down. The time starts when the TA says it starts. You have 2 hours and 50 minutes. When you're done, just bring your exam, and that's it. You're gone. You can leave. questions about logistics? I hope it's straightforward. If you still remember how exams were taken in the past. I mean, the way it's set up, I mentioned to some students that if you're in the afternoon class and you take it, you attend this class, it's okay. So I guess if you take the exam in this class, that's also fine with me too, because I'm just going to write one version of the exam. All right. So I presume that you guys have no incentives to tell your classmates in the other class about the exam. Right. I'm just making that assumption. Yes. You guys have no incentive to tell anybody else what's on the exam. So don't. Otherwise, things can get messed up. All right. Questions, comments? Yeah.
So we just need to print out all the notes, right?
Sorry?
We need to print out.
Yes. Yes. So if you have digital notes, you need to print them out, because otherwise your computer has access to the internet. You could talk to each other, and it's hard to, verify whether or not you're saying you don't have internet. It's hard to verify. So, yeah, reiterate again. All topics up to week 5. That means today, end of today, is fair game. There is a homework. There's no homework assignment this week, so you have not, and then you just have to submit your case study, right? Case studies due beginning of class 11:59, and yeah, which is basically just review of last week's material, anyways. Okay. 8 to 9 questions. Open book, open notes. Just no computers. You can use a calculator if you want, and write in blue and black ink if you want. If you expect it, there might be a chance to regrade. Good. Again, it's designed for an hour exam. In the past, I tried the first hour, take the exam, and then the second hour and a half or so, we do a lecture. But I think students, not many finished. So I want people to finish, okay? So I hope 2 hours and 50 minutes is enough to answer 8 to 9 questions that's like the ungraded problem sets. All right. Well, I'm happy to answer questions later on if you still have some, but the logistics is outlined here. All right, so let's review the quiz questions from last week. I think more than 90% of you got full score, like 3, right? 3 out of 3. So I think most of you, either I explained it very well, or you guys fully understand monetary policy actions from your previous course. But in any case, good job. So let's go over the quiz questions just in case people misread something. So question number 1, if a central bank's target inflation rate is above the current rate, the central bank is most likely to what? A, increase the overnight lending rate, B, buy government securities, or C, increase the reserve requirement. So let's just translate everything to numbers or formulas. So what the prompt is basically telling you is that the inflation target that's set by the central bank, I use pi t to designate a target inflation rate, exceeds the actual realized rate of pi t. So just based on this expression, what this means is that the central bank actually wants to elevate inflation more than what you're observing, right? Pi t. So we need to find an option that suggests that inflation will increase. So if you just look down the list, so let's just go through A, increase overnight lending rate. If you increase the overnight lending rate, you're basically increasing the opportunity cost of holding onto cash. And that's actually going to curtail or undermine the inflation rate. B, buy government securities. You guys are experts at open market operations now, so you know that when you buy government securities, you elevate the price, you depress the yield, and when you depress the yield, interest rates also follow because, again, you're lowering the opportunity cost of holding onto cash. So B looks like a very, very good candidate. C, on the other hand, increased reserve requirement. As we talked in class, reserve requirement, the reserve ratio, is the amount of money a bank has to keep on reserves when someone deposits a certain amount of money. So $100, if it's 50% reserve ratio, $50 of the $100 have to be kept in the bank vaults. All right, that prevents money creation, right? Money growth. And so A and C looks like clearly that they are not designed to facilitate inflation, whereas B does promote inflation. So the best answer here is B. I think most of you got it. I think what's been misread is the the interpretation of an inflation target, right? I think some people got it wrong, but I think most of you read it correctly. All right, question number 2. The open market sale of Treasury securities by the Federal Reserve is least likely to result in A, decreased rate of inflation, B, increased longer-term interest rates, or C, increased exports of U.S. goods. So I think if you did make a mistake, it's because you misread the question. It says least likely as opposed to most likely. So least likely means the answer that doesn't most likely follow as a result of this setup. So if you have an open market sale, that means you're selling something. When you sell something, price goes down, yields go up, interest rates go up. So when interest rates go up, that helps prevent speed of or the growth of money, right? Or the amount of money chasing the amount of goods. So decreased rate of inflation, yes, right? That seems like it's very likely to happen when you have interest rates going up. B, increased longer-term interest rates. That's precisely what I just described, right? So A and B very likely to occur. C, increased exports of U.S. goods and U.S. goods. So just based on the options you have, C looks like it's not a good answer. So the correct answer is C. Comments, questions on this quiz question prompt? All right, last question. Monetary policy refers to actions that influence economic activity by increasing or decreasing which of the following 3. So I think all of you got this correct, more or less. If you just look through it, right, government purchases of goods and services and tax rates on income and consumption, A and C refer to what's called fiscal policy. So that was kind of briefly talked about during class, but just based on, partitioning the answers, A and C look like they're related, whereas B is something else, right? B, the supply of money credit, which is what we've been talking about the entire class last week. Yes? All right, so yes, monetary policy is primarily concerned with controlling interest rates, credit, and money supply. Fiscal policies is about spending or saving money, okay? All right. Questions about any of the 3 questions on the quizzes? Okay, so if no other questions, let's go over the ungraded problem set 4. So ungraded problem set 4 is, there's a prompt, but I'm just going to distill it to the primary thing it asks you to do. So question 1 asks you to analyze what happens when you have a permanent increase in money supply. Question 2 of this problem set asks you what happens when there's a temporary income shock, right? And question 3 asks you what happens when you combine the 2. All right. So the last question is basically forcing you to realize, at least visually, there's 2 types of outcomes that could occur, right? You could have an overshooting event and also an undershooting event. And then it asks you which one's more likely. And as I will show you today with pictures, it looks like overshooting is probably the more likely result when you have these 2 effects coinciding together. So let's just walk through how to analyze these scenarios. So a permanent increase in money supply has 2 effects, as you know. It has a literal increase in money supply through the MS variable, but there's also an increase in E hat E, right, expectations. If any policy that's going to persist from the short run into the long run indefinitely, expectations must reflect that as a result. So just before I draw things, let me explain what's going to happen. What's going to happen is the UIP curve is going to change, right, because E hat E increases. UIP is going to be violated, and domestic interest rates are going to be lower relative to the foreign interest rates. So you're going to borrow domestic and lend out in foreign. And by doing this, by converting domestic to foreign currency from your carry trade, you're going to put upward pressure on E. And that's why you have the UIP shifting up. Yes? So this is precisely the situation in which you have the overshooting effect. So if you see a question on the exam, let me show you what you should be writing down. So most likely we'll analyze this visually. So let's analyze it visually. So on the top y-axis, we have the spot exchange rate. In the bottom, we have liquidity preference. And then the x-axis, we have interest rates, right? Foreign interest rates, as well as domestic interest rates, as summarized by the UIP relationship, or the UIP equation. And let's just have an initial equilibrium starting point, right? And let's go ahead and draw an arbitrary money supply line. And let's call that MS over P. So what two things that happen is there's going to be an increase in money supply. So let's just draw that now. MS, I'm going to use MS prime to indicate that it's a change in MS, and it's an MS that's larger than the previous money supply variable. And another thing that happens is E hat E increases, right? So we all know from lecture slides that that means an upward shift in the UIP curve. So let's just draw a more elevated UIP curve. And let me draw some arrows to indicate the direction. All right, so what happens first when there's a central bank effect here? We have the money market clearing precisely at the intersection of MS prime over P and the liquidity preference line. So maybe I'll indicate that this is LRY. And our new line will stem from here, right? All the way up to the new UIP curve here. Therefore, our change, sorry. All right, let's just do that. Our new spot exchange rate is E prime, and our previous spot exchange rate was E naught. Okay. So in the short run, you can just simply label here, if you want, SR, or just write short run. And then you would write out, if I told you to explain the economic mechanisms, you would write that real money supply changes. How does that happen? Well, they go out and buy securities, right? When you buy government bonds, that increases the prices, depresses yields, and therefore interest rates go down. With lower interest rates, UIP is violated. Carry traders come in and maximize expected returns on their carry trade. And that's going to put upward pressure on E. And therefore, you get a new elevated E. Okay? And all this is possible, again, because prices are assumed to be sticky in the short run. So maybe you can write assume sticky prices. So I guess I'll just, to be complete, let me outline the mechanisms. Central bank, I'm just going to write CB. Central bank buys government bonds, which will increase bond prices, which will lower yields, which will decrease R. Second part is the FX market. FX market carry traders will see that R prime is lower than R star plus E hat E minus E over E. Borrow domestic, lend foreign. This requires currency conversion. You need to sell the domestic currency that you borrow, and so E will increase. And that's why at the end, you have a higher spot exchange rate. All right, so that's the short run, right? What happens in the long run? The long run, because this is permanent, expectations will remain elevated. So UIP curve will stay the same. However, in the long run, so far presented to you in class, prices must chase the change in money supply. So because money supply increased, prices as we transition from the short run to long run must move by the same degree. So we can, what I did to you last week was show you these lines to indicate, well, we're moving from this point here back to our original intersection here. So in the long run, what this is saying is monetary policy has no impact on interest rates. We can, to be clear, we can write LR here to write it's a long run. But because as I said already, because our expectations changed, we still have a more elevated spot exchange rate, but it's slightly lower than the short run. So let's call this E double prime. Sorry, E double prime. And so there is overshooting, right? Because as we move from E naught to E prime actually goes down to E naught double prime, right? So there is a volatility, so to speak, a reversion of the spot exchange rate as we move from short run to long run. So again, we can also indicate that this is LR, long run. So maybe I'll indicate this is short run mechanism. So in the long run, if I ask you to describe what happened, this is what you would write. Something like prices are flexible in long run. Interest rates unchanged, right, from the starting point. And then you can say expectations remain changed. So E remains higher at E double prime, but overshooting due to sticky prices. I don't think I need to write that. But just know that, again, the overshooting is caused by sticky prices in the short run. All right, so this is all review, right? I said the exact same thing last week. Yeah, so just note, again, the hard part, I think, is just reading the prompt and digesting the prompt into something you've seen before in class. And for those of you who have been paying attention in the last 2 years, right, we had a basically global-wide expansion of monetary money supply from literally every country, basically you can imagine, the UK to Australia, New Zealand, to South Korea, Japan, especially the US. And I could just easily present you a context about COVID-19 and central bank policy and lending credit to other banks, and you can all obviously do this kind of analysis now. Yes? Comments, questions on the first question of this ungraded problem set? All right, let's move on to this other event. So this event was also presented to you 2 weeks ago, not last week, but now you can actually analyze this situation with the previous week's context, right, framework. So let's go ahead and do that. So again, as usual, I will most likely ask you to analyze this using a graph and also explain the mechanisms separately. So let's go ahead and have our top y-axis to be the spot exchange rate, the bottom to be real money demand / supply, and we have interest rates here are R star plus E hat E minus E over E. And we always start with an initial equilibrium because it's easier to analyze. What goes on? And let's just assume we have an arbitrary real money demand curve, supply curve here. MS over P, which gives us a equilibrium spot exchange interest rate. Call this R. So what this question is asking, well, what happens when we have an increase in R and Y prime? So as explained to you before, imagine you suddenly became richer, right? Just suddenly you're going to have a 50% pay bump, going from starting today into the future. If you were smart and you smooth your consumption, most people are, right? You would sell some of your assets so you can buy things today, right? So what happens is there's going to be a demand shock on money demand, yes? What that translates to visually is a shift in the liquidity preference curve away from the origin. So I'm going to write L, R, Y prime to indicate that it's to indicate that there has been a change in Y because you have more income, right? Or more output. You can think output and income is the same thing, right? If you produce something, you expect to sell it in equilibrium. Or export it, right? The same thing. You get money. It's from somewhere. All right, so what happens in equilibrium? Well, equilibrium is the intersection of the money supply, money demand, but mechanism-wise, what's happening is people are liquidating their savings, investments in illiquid assets, and now into more liquid assets. So this asset sales will involve government bonds. Selling of government bonds means depression in prices and increase in interest rates, yes? And that's what happens, right? We get an increase in interest rates. And let's call that R prime. Okay. And so just based on the graph, you can see that we have a drop in the exchange rate from E naught here to E prime. Logically, it makes sense because more people are demanding the currency, and as a result, the currency is getting stronger. But you can also think of it from the carry trader's perspective. If you have domestic interest rates increasing, that means carry traders want to come in and borrow foreign and invest in domestic. That requires selling foreign currency for domestic, and that's going to put downward pressure on E. Okay, so let me write down the mechanism here. So here again, we can do separate analysis, short run versus long run. Short run analysis is we have households, wealthier households will sell bonds for cash, and this sale of bonds will decrease prices and increase yields, which means interest rates increase. That's the money market. In the FX market, you have carry traders observing that R prime is now greater than R star plus E hat E over E. And, carry traders and then the carry traders will come in to borrow foreign and lend domestic, which means they need to buy domestic, which will decrease E, right? That's the short run mechanisms. So for clarity, I will circle this and just write SR to indicate it's short run. All right, so what happens in the long run? Well, because we said this is just a temporary, right? A temporary increase, expectations don't change. That means by the time we go into the long run, we presume that the government, in this case, or there's a reversion somewhere, that in which Y disappears, right? It's no longer there. And so expectations don't change, and this curve will shift back, right? It'll be undone. So what you would write here is that in the long run, there's no change, right? Since temporary change in Y. So everything reverts back to its pre-shock levels, and it's as if nothing occurs, right? So if you want to label the graph, you can. You can just say this is also the long run. The long run equilibrium as well. Okay. All right, straightforward. Hopefully many of you can replicate this on the exam. All right, so this last part, I'm not going to outline the mechanism, but I'm going to just draw the graphs because the mechanisms are the same as before. So basically, your task in this scenario is to kind of visually realize that you can draw it in such a way that it looks like there is a dampening effect. So there is a lag effect from the change in spot rate and going into the future, depending on how you draw it. Right? It's not always going to give you an overshooting. You can draw it in such a way that you can actually get so-called undershooting. Right? It just undershooting here just means that the spot exchange rate didn't change enough so that it approaches, or it didn't increase or change enough such that it gets close to the future spot exchange rate. Sorry, the long run spot exchange rate. So let me show you what that looks like. So let's do the undershooting example first. All right, so again, let me reiterate. The y-axis on the top is going to be our spot exchange rate. The y-axis on the bottom is the real money demand, real money supply. And the x-axis is interest rates are r star plus e hat e minus e over e. And as usual, let's just draw our starting point. And let's add some labels here. E naught for our starting point, and this is ms over p. All right, so what we want is a short run dampening of the increase in the spot rate, and then it's going to keep moving the same direction going to long run. So let's just draw what happens when there's a change in expectations first, to show you what I mean. So I'm just going to draw this arrow, and I'm going to label this second line as r star, r equals r star plus e hat e prime minus e over e. And I want to label it such that I get something, something like this, and then maybe something like this, right? So I'm going to label that as E double prime and E prime here. So how do you get this intersection here? Well, as I already said before, we have a shock in the liquidity preference curve, right? So suppose that the liquidity preference curve increased out this far. Or sorry, there's one more thing I want to do. I just realized I need to do one more thing. Yeah, one more thing I forgot to do. Ms prime over p. Let me erase this. Okay. And sorry, just one more. And I want to also, yeah, there. Okay. Yeah, there we go. So hopefully now you can kind of see what I'm trying to do here. This is E prime, and this is E double prime. So let me explain in a bit. This is R prime, and this is R. Okay, so what's happening? What's happening is that we have an outward shift in the output, right, or income. That's shifting the liquidity preference curve away from the origin, but there's it's counteracting the overshooting effect, right? And this counteracting effect is actually dominating over the overshooting. And that's why it's not increasing as much as we want it to be, right? We're actually stuck here in the short run. So E naught increases to E prime because of change in expectations, as well as this increase in our income, right? And so there's a dampening effect on the change in the spot exchange rate. And it's primarily because, again, they have opposing effects, right? So if you look at the previous two analysis, when we have an increase in money supply, it has an upward direction in the spot exchange rate when you expand money supply. But when you have an income effect, it has the opposite effect, right? It has a downward effect on the spot exchange rate. When you combine the two, whichever effect is going to dominate or dampen, it will determine where this spot exchange rate will end up, right? So here it appears that there is a dampening effect such that it completely eliminates the overshooting effect. So you can visually convince yourself, at least with this picture, right, that you can actually get an undershooting when there is a secondary effect from a monetary expansion. Right? So the problem of the question states that, well, when we do these kind of analysis, right, so far in class we only talked about just a single effect, right? Change in monetary policy, change in output. But when we combine two effects here, you can get something like this, right? Something that's a little bit ambiguous. So based on the way I drew it, you can see, right, that in the short run, we still get an elevated E spot exchange rate, but it's not an overshoot anymore. It's an undershoot because compared to the long run, in which monetary policy is undone, it's still below the long run spot exchange rate. So let me explain. Undershoot means that E naught is less than E prime, which is less than E double prime. Yes? So it's as if it didn't approach enough, right, to the long run equilibrium spot rate. Overshoot means that the short run levels far exceeds the long run spot exchange rate. Yes? So that's what we mean by overshooting, undershooting. So undershooting is as if there's a lag, right? It's like it didn't approach enough to the long run equilibrium, and it's still moving in that direction over time. Overshoot means that it went too far in the short run, and there must be some degree of reversion. So as you see from this picture, right, the output increased so much that it basically eliminated the overshooting effect. Yes, it's still increasing, but now you can imagine that if the output line increased even further, it could actually go the other direction, right? Our spot exchange rate could also go down before it goes back up. All right, so that's the first thing you should notice, yes? So basically relies on the assumption, so let me summary, that the change in L far exceeds the change in MS over P. Yes? That's basically what it's saying. The output effect is much stronger than the actual change in real money supply in the short run. And that's why the spot exchange rate looks like there's a delay, right, between the short run and the long run in meeting its long-term levels. On the other hand, so let's look at the scenario in which the change in L is really tiny, okay? Just to exaggerate a little bit. Really tiny change, okay? As if it doesn't really matter at all. So let's go ahead and identify the starting equilibrium here, yes, and then our new equilibrium interest rate here. And let's just draw one of these curves. UIP shifts up as usual. R and R prime. Let's do R prime. And so our short run equilibrium is here. This is a bad drawing too, isn't it? Sorry, let me see. Long run, it's still, sorry, it's. So maybe. Yeah, bad line. Let me redraw this again. So I think I drew it poorly. Right there. And let's amplify this a lot. Okay. So our starting equilibrium, and then our. Yes, here. That's good. This is good. Now we get the same thing, yes? So the R actually goes the other direction, right? And then you would get the overshooting effect here, right? That's E prime. And this is our initial one, E naught. And as we transition to the long run, this is our E now. E double prime, yes? So in this scenario, we get precisely this, right? This result here is precisely what I said here. So let me add some labels just for clarity. Okay, so to summarize again, what's the difference? So as I explained earlier, there's two countervailing effects. A permanent increase in money supply wants to reduce interest rates, right? When you have interest rates ultimately decreasing far enough, you get this overshooting effect as you see here, right? We see the change in the liquidity preference curve growing from here to here, in which the outcome effect is very, very minuscule, very tiny. The overall effect on interest rates is going to be going down, right? Decrease. As a result, you get this overshooting of the spot exchange rate in the short run because you have sticky prices and you also have a change in expectations of the spot exchange rate, E hat E, just like the previous slide. In the long run, everything is undone, but because expectations have increased, you get this reversion, right? Going from E prime to E double prime. You can see this visually here. So let me circle this part here and just write reversion. Conversely, if you have a stronger impact from the output, then interest rates can go the other way. As you can see from this plot here, we have an outward movement from the liquidity curve so much that interest rates actually go the other direction, right? Interest rates actually increase rather than decrease. Then we get what's called an undershooting, because in the short run to long run, the short run is still lower than the long run. So there's as if there's a drag or dampening effect in the short run before we move on to a larger value in the long run. In other words, the short run is going in the same direction as towards the long run. Okay, so this question is intentionally supposed to give you to start thinking about which scenario is more likely, right? It's ambiguous on purpose. So if you looked at the slides today, you will see that it's, in reality, is nothing like the undershooting example, right? Undershooting means that if there's a delay, that means prices or exchange rate shouldn't move as much as we expect it to be, right? When there's a shock, like a monetary shock, in conjunction with a output shock. In fact, we see the opposite. We see that prices are, despite prices being sticky, the spot exchange rate is very, very volatile. It moves a lot, okay? Which is perfectly characterized by this model here, right? This one. Okay, so I hope the way I explained it is clear. So I think the main exercise in this problem is how to deal with ambiguity. So you have to kind of think about what's the key separating characteristic between these two types of scenarios, which is whether or not the change in interest rates ultimately is increasing or decreasing, right? If it's increasing, then you have a different effect on E, whereas if it's increasing, you get a different effect. Comments, questions? Okay, so today's topic is called purchasing power parity. So this is something I mentioned in week 1, and hopefully you heard of it somewhere in like The Economist or something. So the purchasing power parity is just an extension of the law of one price, but we're relaxing the assumptions enough so that we can use it to explain empirical data. Okay, that's my objective today, is try to relax the law of one price and use this condition to make forecasts of long-run or long-term forecasts of the spot exchange rate. All right, so before moving on, I want to kind of do the little bit of math, okay? So as you see from this slide, I want to introduce to you this concept called the rule of changes. So I'm just going to assume that nobody has any background in calculus. So for those of you who just want to memorize, this is what you need to memorize. Whenever you have a product or ratio of something, you can decompose it into a sum of percent changes. Okay, so let me say that again. When you have a multiplication of variables or division of variables, you can always translate that to a sum of percent changes or differences of percent changes. That's from this equation here. So let me give you an example. So, for example, if you have A times B, we can always approximate it as percent change in A plus percent change in B. Whereas if you have a division, say A divided by B, you can always rewrite this as percent change in A minus percent change in B. So you can clearly see why this is useful for us. Again, this is an approximation because our money market equilibrium equation, right, ms over p equals to L, is a combination of multiplication of variables. And then with this rule of changes, we can therefore analyze this equation from a dynamic perspective, right? How things change, how certain variables change over time should relate to other changes in other variables. You can also see this from what's called the real exchange rate, which you saw on day one, right, week one of this class. Q equals EP star over P. Again, combination of variables in terms of multiplication as well as division. We can decompose that equation into, again, percent change sums and differences of percent changes of variables. So that's basically what we need to do today. We're trying to imagine ourselves trying to analyze these stable equilibriums in a dynamic sense, because in the long run, everything changes. So we want to study things in terms of changes instead. For those of you who are mathematical heavy, who want the rigor, well, here's the rigor. You can get this approximation easily if you think about taking the derivatives of log of variables. Yes, when you log certain variables, specifically multiplication of variables, the log of a multiplication of variables will translate to a sum of logs. If you log a ratio, you will get the difference of the numerator and the log differences of the log of the numerator minus the log of the denominator, as I explained here. Yes? So the example I give you here is, suppose we have the real exchange rate, right, Q. Let's just log everything. Yes? So let's log everything. Remember, when you log multiplication, you get sum of logs. Log division, you get log minus log of something else. So log Q equals to log E plus log P star minus log P. It's plus because we're multiplying E times P star. It's a difference because we're dividing. Yes? That's step one, right? We can easily linearize it's a mathematical description. We can easily linearize multiplication division with logs. The second step is realize that if you take the derivative of a log, you get 1 over the inverse of the parameter that's being logged. So here, let's just take the derivative of these variables with respect to a third parameter called time. Okay, it doesn't matter. We can call it whatever parameter it is. So let's take the derivative of each side of this equation with respect to time. And then we apply what's called the chain rule. You don't, again, only for those people who care. The chain rule just means you can just take the derivative of each of the parameters of its function with that specific parameter. In this case, is t. So, for example, if we take the derivative of log e with respect to t, that's 1 over e dt. Okay. Derivative of e over e dt. Okay. You do that for p star and p, and you realize that 1 over dt will cancel out away. They all go away. Right? Because you see d over dt on both sides. And then you just realize that de over e just looks like percent change, right? The d stands for a infinitesimal small change in e, right? Divided by e, that just looks like percent change. Okay, so this is where the approximation comes from. Combination of chain rule along with log rules. All right, so we'll talk more about this later, but for those of you who don't mind the math, then you just need to realize you can memorize this. Okay? When you multiply, you can decompose multiplication of variables as percent change, the sum of percent changes. If you divide, it's a difference in percent changes. Okay, if no questions on this mathematical technicality, which we will use a lot today, let's begin today's lecture. Okay, so up to today, or up to last week, we basically gave ourselves a framework to determine how the spot exchange rate should move in response to certain policy actions, whether it comes from the central bank or it comes from external factors such as like a income shock because there's a technology shock, or you can think about government spending, which also should translate through Y, right? But this isn't very helpful from the perspective of policymakers because everything relies on this sticky price assumption in the short run. This may be helpful if you're thinking about like hedging against fluctuations in E in the very near term. But for policymakers, we want to know whether or not we can affect the direction of E into the far future, in the very, very long run. So we kind of want to impose a condition that reflects so-called long-run condition. And that's going to come from purchasing power parity. We're going to assume that the purchasing power parity, if it holds, will reflect so-called long-run conditions. And we convince ourselves that the purchasing power parity holding is the long run just by looking at historical data. So I'm going to show you in the next slide what I mean. Next two slides. So this is the slide I was talking about for the problem set. So the x-axis here is time. So this is from 1987 to 2002. This is the Deutsche Mark versus the price of US dollars in terms of Deutsche Mark, which is the German currency before they transitioned to the EU. As you can see, this red line, which is the spot exchange rate, there's wild fluctuations in the spot exchange rate. It literally goes up and down over time. So remember, this is changes, okay? Changes in exchange rate. It's wild fluctuations in the changes. The green line here represents the change in CPI ratio. So the same prices are, the ratio is the same ratio of prices as the spot exchange rate. So the spot exchange rate is the price of US dollars in terms of Deutsche Mark, and the CPI is the German CPI divided by the US CPI. And you can see that the prices actually don't evolve as wildly as the spot exchange rate. Yes? So this is not informative, right? The short run model is not really informative for us from policy standpoint. So if anything you should get from this is that overshooting does exist, and it comes from, again, prices not moving so much, right? So where does the movement come from? Well, it has to be coming from the spot exchange rate. All right, so as I said, we're going to impose this assumption, which I'll visually show what that is in the next slide. The purchasing power parity. So let me show you the picture. All right, so same sets of countries. We're talking about Germany versus US. The price ratio is expressed in the same way as the exchange rate. The foreign currency here is the US dollar. Domestic currency is the Deutsche Mark. German CPI is in the numerator, and the US CPI in the denominator. We're looking at a very, very long horizon, right, over 30 years. And our y-axis is the price of US dollars in terms of the domestic currency. So what you should see is that price levels has been quite stably trending upward, yes? And the spot exchange rate, although moving a lot across very short periods of time, it is still actually also moving upwards. So this is the pattern we kind of want to characterize in the long run. So remember, when I say long run, I mean very, very long run. This is like 30 years. And this is, these are policy choices that the central bank and government have an interest in. They want to have kind of guide output of the economy, for example, over long periods of time, perhaps 10 to 20 years out. And the central banks wants to know how can they affect these exchange rates over such long periods of time, perhaps through central bank policy. And I'll show you what policy that's going to look like. All right, so you've actually seen this relationship somewhere during week 1. So let me explain what I mean seen. So if you recall from week 1, you saw this equation. Q equals EP star over P. Yes? So let's rewrite this a little bit. Let's do E equals Q. So let's move the price ratios from the right-hand side now to the left-hand side. So maybe I'll just keep everything to the right, to the left. P over P star equals E. So remember E here. E is in terms of price of USD in terms of euro, EUR. And so this price ratio, this line here, therefore, is P over P star, in which P star is the foreign currency. Yes, foreign price levels, US price levels. And so what this is saying is that this gap, so let me draw a trend line, right, for this E, right? This gap is Q. Do you agree? Yes? So let me explain again. We solved this equation in week 1. Q equals EP star over P. What is that? That's literally just the price ratio between two countries. So in this case, we have E times P star, which is the price of the average price level of the US in terms of euros, divided by the price of euros. Yes? We are now simply moving the price parameters to the left-hand side, right? So we divide both sides by P star and multiply both sides by P. We get Q times P over P star. This ratio is this curve here, this green line here. This E value is this line here. You agree? And therefore, this Q is the relative difference, right? The ratio difference between these two lines. And what we want to do is basically, based on this observation, is to come up with a rationale to explain, well, what kind of theory allows us to conclude that these trend lines must move together? So for Q to remain stable, there's a theory associated to this. This is called the relative purchasing power parity. This is the weakest form of the law of one price that you'll see in this class. Okay, and I'll explain why it's the weakest form soon. But that's kind of where you saw before, trying to connect with what you were trying to do today. Okay, we're trying to come up with a condition that allows us to say Q is constant. And therefore, the price levels will drive the trend of the spot exchange rate over time. Right? So as long as the central bank can somehow control changes in price over time, they can affect the change in the spot exchange rate over long periods of time. All right. Comments, questions? So I hope I didn't lose anybody. All right. All right. So you'll see this graph again. So I'll show you it again in a few more slides later. All right. So objective today: determine the long-term behavior of the exchange rate. So when I say long-term, I literally mean over a 10-year period of time. Again, this is from the perspective of policymakers that want to make very, very long-term control direction of the spot exchange rate because they want to guide, for example, export patterns of a country. All right. This will require us to understand the weaker forms of the law of one price, so that we can impose it and then draw some conclusions. So when we think about long-term, we're thinking about something that must be true in the real sense, okay? In terms of price ratios or in terms of goods and services, right? Okay. So let's start with, to give you the intuition of what purchasing power parity really means, we're going to start with the law of one price that we all are familiar with. The law of one price states that if you have identical goods across countries, arbitrage should not be possible, right? The price must be the same after currency conversion for identical goods. The problem with the law of one price, however, is that there are many, many, many factors of why things could go wrong. Why the law of one price might not hold. As many people mentioned, you can think about tariffs, you can think about differences in competition, monopoly power, you can think about different consumption baskets, right? Different goods. Maybe it's not even consumed in this country. And so we need to relax this assumption this concept into its more average form. So what's called the absolute purchasing power parity is we're now not thinking about single goods, we're thinking about a basket of goods. So when we think about two different countries, we're thinking about averaging the price of a basket of goods weighted by, for example, expenditures aggregated by a country. On average, prices should be equal, right, across countries. That's what purchasing power parity means. All right, even this concept, however, may not hold. Right? As I explained, different consumption baskets. If the consumption baskets are not the same, then you can obviously see that this is not going to be true. Yes? All right, so the weakest form is, oh, well, even if the consumption baskets are different, as long as their consumption patterns is persistent, on average, this it doesn't change over time, that's fine. That's what relative purchasing power parity. We're assuming that the difference between the baskets will stay constant over time, as you saw with Q, right? That's what Q represents, that constant difference, right, between consumption baskets persists over time. So what we saw here in this slide is what's called the relative purchasing power parity Q. On average, seemingly looks like it's persisting over time. So Q more or less remains constant. Okay, so that's where we're going to go. We're going to go to trying to explain why we want to use relative purchasing power parity as opposed to the law of one price, and why also absolute purchasing power parity is also not ideal. Okay, so why is PPP, purchasing power parity, important in the long term? Well, based on what's called the quantity theory of money. So this is, again, something you saw in your macro class. If you don't know what that is, that's fine. Let me explain to you the intuition. Okay. So this is a long-term characterization of an economy. And it's actually very, I guess, tautological. It's kind of obvious the way they describe it. So let me explain to you what each parameter means. So MS, everybody knows, money supply. Now what's V? V is the number of times each unit of currency is spent. This is what they call the velocity of money, right? How much a single currency is spent in the long run, okay? Multiplied by amount of currency in circulation should give us the total money, right, of that's being used for trade, for consumption, or whatever. That's this term here, okay? Number of times each unit of currency is spent. Price, we all know, right? That's the average price. Just think of it as a basket of goods and services weighted and weight their prices. And we also know that we also know why, right? Why is this real income? So let me, I guess, write. This is average prices, and this is income. Real income or real output. Same thing. Real output just means tangible goods and services. All right, so I'll explain one side first and the other side. So that the right side, I think, should be obvious. The units of goods and services being sold, right? This is kind of summarized the average units of goods and services being sold, multiplied by the price will give you total money earned or spent. Yes? So price times quantity equals total income, total revenue, total output in terms of dollars or yen or whatever. Okay? This expression can just be thought of as total money supply or scaled by the amount of times that each unit of currency has been spent, right? So if $1 is spent 100 times on average, then it's just 100 times MS, right? That's the total of money spent in an economy. So total money spent equals total money earned. Yes? Very, very obvious, yes? Very obvious characterization. So based on this quantity theory of money, long-term condition, it matches more or less with what we've seen before in our class, right? If we divide both sides by P, we have MS over P. And if it's a long-term condition, then this term on the right side should be constant, right? So this constant term is just y divided by v, right? But we work with this characterization here, this formula here, L. So just to be clear, let me write equals to y divided by v. Yes. So this is the long-term condition is saying, right? The real money supply must be constant in the future. Okay. And since we're thinking about prices, we can obviously rearrange this equation, right? So that price is only on one side and everything else on the other. And what that is saying is that every parameter in our model can determine where prices go. Yes? All right. P, as I said, represents average prices. But of course, we can weight these prices based on how much a country consumes or spends on. Yes? So if everyone spends tons of money on clothing, then clothing will get higher weight, right, than food or luxury cars, handbags, whatever. Okay? So P is a basket, represents the price of a basket of goods, no longer just a single good in this framework now. Okay, so we're going to now reintroduce to you the real exchange rate. Again, the real exchange rate, again, is just a ratio of prices between foreign and domestic. It's unitless because it's just prices divided by prices. And when we say the Q increases or decreases, it's the same intuition when we think about the spot exchange rate E. So Q can appreciate and depreciate the same way as the spot exchange rate E. Yes? It just represents now, as this term means, purchasing power, right? It represents purchasing power in terms of real goods and services rather than just nominal terms with currency, right? Conversion. All right, so let's slowly move towards the concept of the relative purchasing power parity. We start our analysis by introducing to you the strongest form of the law of one price, which basically states that the price of identical goods across countries must be the same after currency conversion. Why must this be true? Well, otherwise there's arbitrage. You just borrow, sell high, and buy back cheaper, right? Borrow, buy low, sell high. And I'll give you an example here. So I hope this is, again, obvious. Many, many reasons why this might not hold, as I explained week one, right? Tariffs, competition, quotas, anything like that, right? These things could all disrupt, make this unable to be true. So we can relax this. So rather than talk about every identical goods, let's talk about a parity that could be true if we're talking about averages. So average prices just means that we're talking about capital P now. Capital P represents weighted average of a basket of goods and services for one country versus the price level of a basket of goods for another country, P star, but we convert it using E. If we want to put it in the framework of the real exchange rate, it means that Q is equal to 1. Right? I hope that's easy to see. All right, recall that the real exchange rate is equal to EP star over E star P. So if Q equals 1, then P equals EP star. And that is also saying that these two lines should overlap, right? If we have absolute purchasing power parity being true. Yeah, so this expression, again, refers to absolute purchasing power parity. Basically means that average prices of goods and services between two countries are the same. All right, so I hope so far so good, right? First, we talked about very specific goods. Now we talked about a basket of goods, right? Maybe not all goods have the law of one price holding, but on average, maybe, yes? Okay, but even this might not be true, might not hold. Again, as I explained to you, you have different basket of goods between countries. Well, if we have different basket of goods countries, then Q is not going to be equal to 1, right? Something else. And so we have the weakest form of the law of one price called the relative purchasing power parity, or relative PPP. What this is saying is that, well, Q may not be equal to 1, but at least it's equal to something that stays constant into the future in the long run. You can also write it in a dynamic sense, in which the change in Q over time is 0. So QE minus Q divided by P is just percent change in Q, right? E is some future value. So the future value of the real exchange rate over time should be equal to 0. But that's the same thing as saying Q is equal to some constant. Yes? So I'll highlight it here. When we're talking about relative purchasing power parity, we're assuming that Q is a constant. Or you can think of it as the percent change in Q over time is 0. Right, so if you're going back to this graph, if you smooth out this line, right, we can safely say over this 30-year period that relative purchasing power parity more or less is satisfied. Yes? Of course, I will show you deviations away from this and provide you an explanation of why that's true. So comments, questions on definitions? So let me summarize, okay? And then I explain to you why, if the stronger form of law of one price is true, the weaker forms must also be true. But let me summarize definitions first. The strongest form of law of one price you've seen in your other classes, identical goods must have identical prices after currency conversion. Could be violated for many reasons. And we can relax our assumption of law of one price in a macro sense by talking about average prices. We can talk about average prices by restricting ourselves to now a basket of goods as opposed to every single good. When we restrict ourselves to just a basket of goods, we can impose what's called the absolute purchasing power parity, in which we're talking about country's consumption basket to another country's consumption basket and average those prices. In the real exchange rate definition, it means that Q equals 1. But as I explained earlier, consumption basket preferences can be different across countries. And Q won't be equal to 1. Yes? It's very easy to imagine, right? Look at Japan versus US. You can imagine hot dogs, hamburgers, sushi, and I don't know, video games. Totally different things, right? So you can see, you can verify yourself. Right? There is a gap between price ratios and the spot exchange rate over time. So relaxing this assumption further, we end up with the weakest form of the law of one price, called the relative purchasing power parity, which states that, well, even if they have different consumption baskets, those differences persist in the long run. And so we're basically saying that from the real exchange rate perspective, that the gap is constant. From a dynamic perspective, what that means is that the change in Q should be equal to 0. So let me explain to you why the stronger form implies the weaker form. So I'm going to show you that if law of one price is true, then relative PPP is true. This can be shown by the following. So law of one price states that this must be true. Yes? Sorry, P star. Right, for every good. Now we simply weight each price by its corresponding basket weight. Let's call it A. PI equals to E times A times PI, P star I. So maybe I put an X here just to know I'm multiplying. That's step one. Step two is to sum everything, right? So let's sum. Let's just sum it. When you sum things, there's a constant. You can factor out the constant. So let's move the E out. And we all know what this is, right? This is capital P. And this is E capital P star. Yes? So stronger form of law of one price implies the weaker form. Now, relative PPP implies, absolute PPP. Sorry, this should be ABS. Okay, absolute PPP. Absolute PPP implies relative PPP is quite obvious. Because absolute PPP states that Q equals 1, and 1 is a constant. So relative PPP holds. Done. That's it. Very simple. OK, comments, questions on the three different forms of the law of one price? So what this means, what the proof means, is that just because relative PPP holds doesn't necessarily mean that absolute PPP hold or law of one price holds. Right? Various reasons why that's not true. But if the strongest form holds, then all the weaker forms must hold. All right, no comments, questions. Then let's move on to our key takeaway. So this is just a review of the rule of changes, which we'll use a lot. Okay, so since we already covered it, I'm going to skip this slide. So the so-called monetary approach indicates that we're focusing on the long-term forecast of the spot exchange rate. So we're going to use the same ingredients as you saw from the asset approach, right? We have the uncovered interest rate parity as well as the money market equilibrium, but we're adding a third condition now to make inference, which is we're going to assume in the long run the real exchange rate is equal to is a constant, it's unchanging, as you saw empirically in the graphs. Yes. So relative purchasing power parity holding means that the change in Q over time is 0. So let's draw some conclusions based on this holding. That's what we're going to do. And we're going to get the so-called long-term condition. So we want to show that the percent change in E, or the expected depreciation of the domestic currency, is equal to the difference in inflation rates between two countries. This is the so-called long-term condition. Another way of saying this is that our spot exchange rates percent change over time is only explained by differences in which prices change over time between countries. So we can prove this quite easily. So rather than write, I'm just going to show you the next slide, what gives you the proof. Okay. So what we do is we start with the real exchange rate, Q equals EP star over P. And we apply the rule of changes. Rule of changes, again, is if we have a multiplication of variables, we can do sum of percent changes. If we have a ratio of variables, we can do differences of percent changes. So here we have a multiplication of two variables. So we can decompose Q in the numerator as percent change in E. That's E hat E minus E over E. Yes? Plus percent change in P star. P star E minus P star over P star. So far, so good. Yes? We're just applying rule of changes. Second part is EP star is dividing by P. Based on the rule of changes, we can subtract percent change in P. So that's why it's a minus here, PE minus P over P. So this equation here is now completely dynamic, yes? If we impose relative purchasing power parity, percent change in Q must be equal to 0. So with this formula in hand, we can now rearrange it to look like this very easily, right? Move the changes in prices all to one side, yes? And we get E hat E minus E over E. Inflation is just percent change in prices, yes, for each of the countries. And we have the long run condition. Okay? So we will impose this condition in our existing model to make forecasts in the subsequent lectures. Okay? Yeah.
When does relative PPP not hold?
I'll talk about that. I'll talk about that at the end of the latter half of this set of slides. Okay. So preview. This primarily holds in developed countries, as you can imagine. When you compare developed countries with emerging economies, this definitely will not hold. And I have an example with Japan in the 80s, in which they had a productivity boom, and that's going to distort the real exchange rate a lot. Okay, I'll show you soon. Okay, so far so good, right? Just something you've seen before, applying a mathematical trick to think about dynamics. We decompose the real exchange rate into its percent changes, impose the relative purchasing power parity condition, and we get a conclusion that price changes is what drives the change in the spot exchange rate in the long run. Okay? And we will further decompose inflation in the next few slides so that we can have monetary policy implications. Okay, so we can go one step further. Okay, one more inference. If we impose UIP, and you can see what happens, right? UIP tells us that differences in interest rates must be equal to the change in the percent change in E. You match these two terms, and you realize that, in fact, if we impose relative PPP along with UIP, you get that inflation rates must explain differences in interest rates between countries. Okay, this is called the international Fisher effect, or just Fisher effect for short. Yep.
For inflation rates and interest rates, is it are they just moving together? It's more of a correlation, or is it causing? Is it correlation or causation?
In this setting, we don't care about causation. All right, or yeah, we don't care about causation. Everything determines everything else. So everything's depending on each other. That's this. Yeah. So in the long run, nothing is fixed. Nothing is external. Every parameter depends on every other parameter. So here, when we talk about E here, and E hat E, everything is moving at the same time. So everything changes. Okay. If you want, when you say causation or correlation, well, this structure tells you that. I guess if you want to think about from A causes B, then yes, there is. We're imposing structure, right? This is a way to think about it. Correlation just means we don't know the structure. Here we know the structure. Yes, we know how things should move in the long run. If you believe this structure, of course. Okay. Yeah. So if you based on the slide you saw, right, the spot exchange rate and the price ratios between two countries, like the U.S. and Germany. If you believe this structure, then there's a causal mechanism, right, going on, underlying the movements of the price ratios in E. So this is more than just fitting a regression, as you saw, right? Regression is just correlation. Here we have some structure, so we know what's going on underneath, behind the numbers.
What would be the intuition behind inflation's relationship with interest rates? I see.
Yes. Okay. So that's yes. Good question.
See it for the first one.
So good question. The intuition here is R is forward-looking. Okay. So if R is forward-looking from the perspective of the central banks, then inflation, R is going to move at the same direction as inflation. So I think in the previous model, we kind of just took R as something as a given, right? Here, R is being guided by inflation. Does that make sense? So that's the intuition. So the intuition is here can be decomposed. We know where this comes from. It comes from changes in P. P comes from the money market equilibrium model. And the money market equilibrium model has two components of interest. One is L, and the other is MS. So central banks can control MS, and to some extent control inflation. And so R is now kind of forward-looking rather than just something you take, at a fixed time. Yes? So that's how you should think about it. You'll see it clearly when I show you what I just said. Okay. All right. So let me conclude on this slide, and then we'll take a 10-minute break and pass out the quiz. All right. So as somebody curiously asked, so here's the intuition of the long-term condition. So we can further decompose the long-term condition if we recall the money market equilibrium equation, right? MS over P equals L. But now we just rearrange the terms so that we have P on one side and MS over L. Yes? Apply the rule of changes again. We have percent change in P equals to percent change in MS, and percent change in L. That means we can decompose this into two parts, right? Each inflation term, which I wrote here. Yeah. Domestic expected inflation is how fast money supply grows, right? And how fast money demand grows. Same thing for foreign inflation, how fast their money supply grows and how fast their money demand grows. Plugging these inflation terms in here, you can see that it's monetary policy tightness, right, between countries. How fast is money supply accommodating demand that drives the expected depreciation of the home currency? So based on this decomposition, you can see that central bank has an additional tool now, not just for the short term, but in the long term. If they can impact the speed at which money supply grows, they can impact how the domestic currency is going to change far into the future. So that's the important takeaway. The speed at which money supply grows can now be an additional tool for the policymakers. So two more things I need to talk about. One is this new policy tool that people can use, central banks can use to affect long-term changes in the spot exchange rate. And the second thing I want to talk about is violations of the relative PPP, and as I mentioned, what it looks like, and then show you what it looks like when it's violated when you compare developed countries with emerging economies. All right, so this additional policy tool we're talking about is rather than a single jump in the money supply, you can change the speed at which money supply changes over time. Okay, so the difference is actually is much subtle it's very subtle. Okay, so let me just go through the example in which we change the speed at which money supply changes, and then show you how that compares with a single shot increase in money supply as you saw in the last few weeks. Okay, so for this accelerated money supply growth, let's suppose instead of increasing a one-shot increase of money supply, we're thinking about many one-shots aggregated over time, in which it looks like the speed at which money supply grows is different than before. Okay, so what does money growth look like? It looks like inflation, right? So if we change how fast inflation grows, let's call it delta pi, then we can accelerate how fast delta pi changes through changes in MS in money supply. Yes? So instead of increasing, let's say, $1 million per year, you can increase by $2 million every year in money supply. Okay, so by the Fisher effect, as you saw in the previous slide, right? If we increase inflation, which you increase through money supply, that will change interest rates, the speed at which interest rate changes over time as well. Yes? So remember, Fisher effect is R minus R star equals to inflation minus inflation star. Yes? If you change domestic inflation through change in money supply, that's going to show up in R, right? Through this delta pi. So R prime is the new interest rate because of this change in speed of inflation. So what I'm going to show you graphically is when you increase the speed in which increase the speed in which money supply grows, there's going to be changes in the price level as well, okay, which is obvious, right? And I'm going to show you what's going to happen. You're going to first experience a jump in prices. I'll show you graphically why that must be true. And then we will show you that faster money supply will also lead to faster price growth. And ultimately, the key takeaway is that the spot exchange rate must follow the price level change in P. All right. So what is change in the speed in which money supply grows? Well, it looks like this top left-hand side graph here. So here you can imagine that this slope here is just pi. Yes? Let's call it pi. Okay? And we change the speed. Or maybe I'll just write the symbol pi. Okay? And we change the speed here, right? This kink here. There's a change in speed. So here we have pi plus delta pi. So remember, it's not a one-shot increase in the money supply. It's a speed change in which money supply grows now. So multiple steps. So the increase in our steps over time is now taking a bigger step. So you see this kink, which represents the speed at which money supply now is different than before, right? So what you're going to see first in price levels is actually a jump. And I'll explain to you why that's true. So the reason why you see this jump is because P equals ms over L R y. And it comes from the fact that R will now increase. So that's kind of the counterintuitive impact that you saw in the previous lectures, right? We think about increasing money supply, we think about interest rates falling. But now, because interest rates are forward-looking into the long term, changes in money supply, the speed at which money supply grows in the long term, must lead to interest rates also moving in the same direction. So this sudden drop, increase in R, will actually decrease L, right? And therefore lead to a jump in prices. So before this policy action of accelerating money supply, P also was growing at pi, right? But because of this accelerated movement in money supply, we have this jump. And now we have also faster growth of prices at now pi plus delta pi. So as I said, interest rates now increase because of the fixture effect, and then remain constant over time. So this gap here is delta pi, and this is from Fisher effect. And maybe just for additional clarity, let me write out what Fisher effect states. R minus R star is equal to pi minus pi star. If you change the speed at which money supply grows, you will affect pi, and pi will reflect that change through P. Because everything now is forward-looking into the future. And to remind you again, this is counterintuitive what you would think about when increasing money supply in a short-run model, right? And finally, we can see from the long-term condition, just to remind you what that is, from relative PPP holding, that's E hat E minus E over E, pi minus pi star. So what this means is that we should see the jump in prices too, in E as well, followed by also a change in slope. So a jump, and also a change in slope, just like P. So this slope is different from this slope. This is this is pi. This is pi plus delta pi. This is the long-term condition. Okay, so let me briefly summarize again. We've introduced this new policy tool. Rather than changing just a one-step increase in money supply, we can think about changing the speed at which money supply grows over time. So everything's dynamic now. Everything's forward-looking. If we change the speed at which money supply grows, that's going to appear through inflation, and as a result, appear through interest rates. That's why we see this jump in interest rates because of this change in the speed at which money supply grows, and that's going to be reflected in prices. So even though there's no jump here, there must be a jump here because of the long-term condition that the real money supply, real money supply must be a constant, yes? So increase in R, decrease in L, which will increase price. So we see a jump here followed by a change in slope. The change in slope is because price levels are evolving at the now elevated speed at which of delta pi, yes? All right, so now we know why this changes, why this changes, why this changes. Now E here, this changes the same way as P because of this long-term condition, right? Because of pi, E must also reflect the same thing that occurs in prices. So we see a jump in E as well as a slope change in the evolution of E as well. Okay. All right, so let's compare this. Let's compare this with this one-shot thing before, right? The one-shot increase in money supply. So why does it look different? Well, in the setting we were working with in the past 2 weeks, we assumed that inflation was basically 0. So in other words, suppose inflation 0, right? Inflation is 0. Sorry, my pie doesn't look very good. Inflation is 0, and also inflation is 0. Yes, before and after the policy action, our inflation rate is 0, just a flat line. This jump, we have inflation infinity, but that's just going to look like a blip in the short run, right? So if we look at, again, the price equation, P equals ms over LRY. In the long run, between short run and long run, no change in inflation. So Fisher effect tells me if there's no change in inflation, there's no difference between long run and short run interest rates. Yes, so in fact, R just looks like a flat line. Yes, if you want to be precise, there's like a blip, right? There's some blip, but between short run and long run interest rates, they're the same, identical, because inflation didn't change, still 0. So let me write out the Fisher effect again. Equals pi minus pi star. And price levels, there's no change in R, but we have ms changing, yes? So P just follows ms, right? Just like the model we worked with in the past. And because of the long run condition, I'll write it out again. So E hat E minus E over E equals to pi minus pi star. E must follow P. All right. So as you can see, it's very different, primarily because this jump is driven by the change in the speed at which money is created, right? This delta pi. Pi is assumed to be 0 in our very short run model, so it's still 0. The speed is still 0 as we move from short run to long run. And as a result, the jump is not from the change in the speed, this jump is just simply coming from ms, okay? And just based on the long run condition, E must trace or follow P. And yep, those are the implications. Now, if we have those, if we impose relative PPP in our old framework, okay? Okay, so your question may be, okay, how can I ask this question on an exam? All right, so it's important to make a distinction between the so-called short run model versus the long run model. So the short run model is exactly what you saw in the last week, the comparative statics with the graphs. So on an exam, if I asked you to analyze this short run and long run, then you can simply just draw those two graphs, the UIP curve and the money market, and then shift those curves and then analyze short run, and then see what happens with prices, and then tell me what happens to the other variables. When I tell you the long run condition must hold, you can simply just assume relative PPP is true. And then you can derive something mathematically. All right, so that's the hint, in case you were wondering. Okay. All right, comments, questions on the so-called long run condition and its implications on how those predictions are different than the short-term model. So I highlighted this fact in this bullet point here, okay? Just remember, in the long run, everything is forward-looking, everything depends on everything else, everything is subject to change. So when you change interest rates, you change inflation, that's going to translate into interest rates. But in the short run model, because things are fixed, right? We have sticky prices and all those things. You're going to get opposite predictions. Just to remind you guys. So work through this example right here. I told you like you're going to get opposite predictions on how interest rates should move when you change money supply in the short run versus the long run. Okay? But really, they're two different things, right? The difference here is that when we think about long run, these one-shot changes in money supply doesn't really matter. What matters is like an aggregate sequence of steps of these jumps, right, in money supply. In other words, the speed at which money supply changes only matters. Okay? And when you're concerned with speed, then everything is forward-looking, everything changes, and therefore money supply will have a positive impact on interest rates. But you'll get the opposite for that one-shot scenario. All right, so comments, questions. So if you're lost, don't be afraid to ask questions now. There's no ungraded homework set this week again, so these are the only exercises you get. Okay. Okay, so what do we have to work with now? So we have the so-called asset approach, where we're basically concerned with two markets. The UIP, which represents the FX market, and also the money market, which represents the market for money supply and money demand. Today, we introduce to you the real side that supposedly should be true in the long term. Right? In the long term, nominal things don't matter. Money doesn't really matter. All that matters should be tangible, real goods and services. So something that represents this equilibrium is relative PPP. So if we impose this, we can therefore get more insight, more inference ability, and therefore hopefully make some accurate predictions about where spot exchange rate should go 10 to 20 years to 30 years out. So of course, you may think that there may be some inconsistency. Well, it appears so, but there is a relationship, and it's captured through E hat E. Okay, so we will talk more about this in the subsequent weeks. But just to know that these two concepts, this third relationship, is not inconsistent with these two frameworks. So let's summarize a bit the formulas we have at hand so that when you do the exams, these are the formulas you think about. All right, so long run condition. How do we derive it? We derived it from the real exchange rate and applying relative PPP. When you have relative PPP equal, then you know that the real exchange rate changes over time, must be equal to 0. And therefore, you get inflation rate explains differences in inflation rates between countries, drives long-term evolution of the spot exchange rate. All right. So number 2 is this money supply equal money demand formula. So in the short term, the so-called short-term model, right, when we plot those UIP versus money market, we assume that P is fixed. It's an external variable that we just say it's a constant. But when we think about the long term, or the so-called monetary approach, P is dependent on every parameter in the model. Okay? So P, therefore, is a function of MS, it's a function of R, and a function of Y. So all these variables can impact how P should go. All right, so combining the long-term condition, which is, again, just saying relative PPP is true, along with this formula that you know already, you can arrive at the so-called Fisher effect, which states that inflation rate differences explains interest rate differences. Okay. So based on that graph, I hope you are more or less convinced that at least for developed countries with similar consumption behavior and consumption baskets, relative PPP should more or less hold, at least for very, very long time horizons, right? You can do that yourself, of course, comparing US with UK, Australia with Canada, Canada with UK. You'll see that, in fact, relative PPP or even absolute PPP you might presume to hold. However, testing is very complicated. You need very, very long historical data. Yes, so it's hard to actually, even if we visually inspect, it's hard to test empirically using statistics. All right. So back to this graph. Hopefully you're convinced now. And now I want to show you why, kind of go over the reasons why each of these versions of law of one price fails. Okay, so empirically, how often do these fail? Law of one price, as talked about for the first week, fails frequently. We can easily come up with examples why those fails. You can talk about domestic industries that countries want to protect. For example, in Amsterdam, they don't want Chinese bikes being flooded, so there's like a 50% tariff on bicycles in Amsterdam. So these can affect the law of one price for bicycles. If you look at just US cities alone, you can look at that certain goods and services, or you can think about just cost of living in general, varies within country. Yes, think about France. Think about not only US, France too. Yes, there's rural, there's urban areas, and based on demand and supply, of course, of goods and services, and the transportation costs, that can explain why the law of one price doesn't hold. All right, purchasing power parity, again, depends on how long of a time horizon you're looking at and also what kind of countries you're looking at. But for the most part, macroeconomists agree that PPP, more or less, either they're absolute or relative, more or less is true, conditional that the countries you're looking at or comparing are very, very similar. And even if there's deviations, there is, of course, a reversion towards its equilibrium constant. Okay, but it takes time, as you can see from this graph here, right? It looks like they're moving together, but then there's sudden deviations. But then eventually, this is like a 5-year period, right, before it starts to turn around. Okay, so it's very, very slow moving. So we're talking about very long-term forecasts in this setting. Okay, so short-term failure of PPP. Let's try to come up with reasons why PPP fails. So the first reason and the third reason I think is kind of trivial. It's obvious. So if there's, just think about like, so the first one is about monopoly power. So some countries have very competitive industries, like in terms of, for example, I don't know, sodas. But for other countries, they only have one source of soda, like Coca-Cola. Then you can imagine Coke can just raise prices and they don't have a choice, right? And in that sense, you can see that prices between countries for the same good could just be violated. Obvious. Transportation costs, of course. There could be differences in insurances, for example. So if there is a there's a country undergoing war, as you can imagine, if you want to deliver those goods safely, and there's a war going on in the ocean, those insurance rates on freight could be large, and those costs can be transferred to the customers, right? So sometimes, I write 10% here. Of course, it could be even more during war. In any case, these are, I think, obvious reasons why relative PPP or absolute PPP might deviate in the short term. Tariffs, Also, I think a little bit trivial. These are imposed by the government. Of course, if it's monopolistic, if you have an industry that's monopolistic and you impose tariffs, that means that the firms may just absorb the cost of the tariffs, okay? Because they're already setting prices at optimal, maximize profit extraction from their customers. So even if you have tariffs, it doesn't necessarily mean that prices will change, okay? But you can easily see why tariffs could impact prices because they could spill over into customers, the same way transportation costs do. The more interesting explanation of why relative PPP changes is this point here, okay? Non-traded goods and productivity shocks. So you can imagine a country's consumption basket being split into two parts. One called the tradable goods sector, and the other part called the non-tradable goods sector. And when you introduce productivity shocks, the production of one sector may not necessarily could actually impact the prices of another sector. So the example I want to provide you here is think about real estate in China. So over the last 10 years, you know that China has been really good at producing smartphones, right? So per unit of labor, they can produce a lot more in the past 10 years. So what do they do with this extra income? Well, a lot of that income is not being used to buy tradable goods and services. Tradable meaning that you can put it on a ship and that ship will go back to China and you can just consume it, like oranges, cherries, blueberries, computer electronics, or whatever. Okay, these things can be put on ships and moved to other countries. So what do I mean by non-tradable goods? I'm talking about land, real estate, haircuts, things that you have to consume within proximity. So as you can imagine, when Chinese citizens become wealthier from being really good at producing smartphones, a lot of that money is actually being moved to non-tradable goods like houses and real estate. And because of that, you can see deviations of the real exchange rate away from its long-term levels, or the long-term levels is changing over time. Yes? All right, so that's an example. Okay, and let's talk more about that last example. So the way to think about productivity changes is just imagine that the country gets really good at doing something, and now they can produce more units and therefore be paid more for the same amount of work they put in. Okay? What do they do with this extra income? They can use it to buy, as I said, tradable goods. If it's more expensive at home, that's fine. They can import it. So in the end, the price equilibrates. Non-tradable goods doesn't have that option. You cannot import a house, right? You can't import land. You can't import a haircut. Yes, you cannot do these things. And so what happens is all that income is going to push up the prices of these non-tradable goods. And these non-tradable good prices are going to be reflected in the real exchange rate, right? Q equals EP star over P, right? The domestic P captures this productivity shock, right? As reflected by people spending their money now on non-tradable goods. So the example I gave you was real estate. Of course, you don't have to do real estate. You can do haircuts, right? It doesn't have to be haircuts. It could be restaurants. It could be like luxury services, whatever, like massages. Anything that you can't trade and put on a ship and move to another country can reflect these productivity shocks. Another example is like, I don't know if you've been to like Silicon Valley or Los Angeles, where there's a lot of wealthy tech workers. If you want to buy Chinese food is crazy expensive there, despite being of lower quality. Okay, so as you can imagine, there's lots of Chinese workers. They're using their income to buy Chinese food. Okay, and they cost more than here, surprisingly. Okay. So yeah, so this is the example I gave you here. We have cars. So cars is like Japan. The example I give you here is Japan. It doesn't have these smartphones. Now you think about cars. better at producing cars than the US. So they use that extra income to make investments in stocks and bonds in Japan. They use that money to buy real estate. So overall price levels in Japan skyrocketed during this period. Right? Because they can't import land, they can't import services, they can't import haircuts and so forth. So local prices must increase as a result. Right. So yeah, so I use the example as Hong Kong too. So Hong Kong real estate as well. Yeah, Hong Kong's really good at services. They're really good at providing legal services, financial services, operations, import-export services, and all that additional expertise translates to more income. And what do they do with extra income? So rather than importing, consumables they can put on ships, they just throw it all into real estate. Yes? And as a result, not surprisingly, asset prices increase, and you can see deviations of the imbalances you can see fluctuations in the real exchange rate over time. For example, during the 90s, right? During the Asian tiger period. So what does this look like mathematically? All right, we can see this mathematically too. So look at the real exchange rate equation, Q equals EP star over P. Now we can decompose each of these prices, P star and P, into non-tradable sector and tradable sector. So T here stands for tradable. Alpha is just the weight, associated to the basket of goods that a country consumes on average. NT stands for non-tradable. Yes? So just for the sake of simplicity, we can imagine that if tradable goods becomes more expensive domestically, it's easy to substitute away from it, right? You just simply import this identical good from somebody else, and therefore law of one price restores, the price, equilibrates the price. For non-tradable goods, however, there is no import option. You cannot substitute away from Hong Kong apartments. You can't substitute away from Chinese apartments if you live in Hong Kong or China. So what's happening is non-tradable prices are increasing. So from here you can see that if we have a productivity shock, for example, okay, what's going to happen is that non-tradable goods are going to increase. Yes? And therefore the entire Q is going to decrease. So what happens as a result of the productivity shock and people moving their money and putting their money into non-tradable goods is that they're going to experience an appreciation of their home currency. It has to happen, right? Because they can't substitute away from non-tradable goods domestically. Clear? So what I'm describing is basically a spillover effect from the tradable goods sector. So the example I give you here is, suppose a country becomes better at doing something for a tradable good. And I gave you an example with cars, I gave you an example with smartphones. Cool. So you're better at producing things that's tradable, and you earn that extra income. With that extra income, rather than importing certain goods and services, you decide to buy things domestically that you can't find a substitute for abroad. Houses, haircuts, restaurants, all these things will increase because you can't import these things. And as a result, prices have only one way to move, right, for these non-tradable goods, and that's upward. If you have an increase in prices, you must experience a real appreciation of your home currency. So that makes export harder. Yes? All right, example, as promised. The example I want to talk about is Japan. So I'm assuming the foreign currency is JPY and the domestic currency is US here, okay? So this is what the benchmark is. So these numbers don't mean anything, okay? It's indexed. But just note that the y-axis represents JPY, the price of JPY in terms of US dollars. So what we're observing here, this black line is the real exchange rate. So that's Q. This line here is P over P star. Okay. So just to JPY is the foreign. Okay. And USD is domestic. So as I already explained to you, right? If you have a productivity shock that leads to more people putting money into non-tradable goods, then you should experience a domestic appreciation. So you should see US dollars here weakening. And this is precisely what we see with this dashed line here. Right, this dashed line. This is the nominal exchange rate, but you can also look at it from the perspective of the real exchange rate, the solid line. So overall, from 1960 to 2000s, you see that on average, the real exchange rate has depreciated for the US or appreciated for Japan, right, as predicted. And you can see where that's coming from. Look at the price level. Remember, P star is Japan. So price levels has, in fact, been increasing over time precisely when Japan experienced that 1980s productivity shock. They got really good at producing electronics, cars, and basically the US was scared, right, that Japan might actually overtake. In fact, I think they did for a period of time. Japan had the largest market cap in their equities market, larger than the US during the 1980s. Okay, so based on this graph, it's clear to see that our relative PPP assumption definitely is violated, right? Relative PPP states that Q is stable over time, right? Either equal to 1 or a constant, yes? But here, look at what's happening. It's fluctuating wildly since 1980, right? Or even before, 1970s. You can see this in China. If you compare China with the US too, you can see this in Taiwan and Korea. You'll see the same patterns, okay? And I think for those of you who have parents that grew up during the Asian Tiger period, or those of you who are Japanese descent, also probably saw the same thing. Your currency got really strong during that period of time. All right, so whatever I just described, there's a name, okay? It's, I think, a very critical finding and quite intuitive, okay? So the name for this, what I just told you about the productivity shocks in non-tradable and tradable goods sector, it's called the Balassa-Samuelson effect. And what their finding indicates is that for countries that are very developed, you obviously see price levels much higher, right? And you can confirm this by going to these countries yourself. Go to the US, go to New York City, go to San Jose in California. Come to Hong Kong. Price levels are really, really, really high here. And it's precisely because most people are dumping their, as confirmed by economists later on after Balassa-Samuelson, people were dumping money into non-tradable goods. Okay? Obviously, you're eating out more, you're buying, people are investing in local real estate, and so forth. So, well, that's good news for those of you who had low prices, right? Countries with lower prices, you should probably think about investing in these emerging economies before prices get too high, out of control. Okay, so comments, questions on that description of why relative PPP can be violated in the short term? Okay, so the last thing I want to talk about is an additional conclusion about the relationship between real interest rates between countries. So maybe I'll talk about that first. Let's just go to this one. So let's first convince ourselves that the difference in real interest rates. So remember, real interest rates is nominal interest rates, but we remove the inflation part. Okay, the real interest rates between countries must be equal to the percent change in the real exchange rate. So the derivation for this equation comes from the Fisher effect that you know, right? Which is the decomposition of nominal into its real and inflation part. So how do we do that? We, again, just use the rule of changes on the real exchange rate. So using the rule of changes, we see that the percent change in the real exchange rate is equal to the percent change in the spot exchange rate plus foreign minus domestic inflation rate. Imposing UIP along with this equation here, we can therefore arrive at this equation here, right? So substitute R with R and E, lowercase r, yes? And then we have the following equation here, yes? And you cancel everything out, right? Cancel the inflation terms out. And you should get precisely this. So just to highlight the steps, these are cancels out with this. Okay. So cancel all the inflation terms, you get precisely this relationship. So even if we assume that relative PPP doesn't hold, we can still conclude that this change in the real exchange rate must be explained by changes in the real interest rates, differences in the real interest rates between countries. So if you can quantify this from macroeconomists, they probably can, those at the central bank, you can also know the path at which this changes as well. Of course, you have to assume that this is true, okay? UIP. All right, so even if we impose relative PPP, there's one final conclusion you can make, right? If relative PPP is true, then this right-hand side expression must be equal to 0. And that means that in the long run, real interest rates must be the same between countries. Okay, so let's summarize a bit. Maybe I go back a slide. And this one. Yes, okay. So to make the distinction between when relative PPP is true and relative PPP is not, when relative PPP is true, P and Q must move together. Yes? Sorry. Sorry. E and the price ratios must move together, right? As you saw in the graph. Q is a constant. Yes? As you saw in the graphs that I showed you before. When relative PPP is violated, two things can change. Q can change, as well as P. And one way that can occur is through productivity shocks, right? Positive productivity shocks. So the example I give you is getting better at making smartphones, getting better at making cars. That's going to translate to bidding up the price of non-tradable goods. But you can also think about other ways in which there is a change in prices, right? It can come from a sudden increase in higher demand for domestic goods, right? As long as P is changing somehow for some reason or another, that can impact Q and P at the same time. So we focus on this because it has an interesting economic mechanism, right? It comes from countries evolving from emerging to developed, and that's going to push up domestic prices upward. That explains why developed countries' prices are so much higher when you go there, right? Locally, getting a haircut, anything. Okay, and so I want to summarize today using this last slide here, okay? So compared to the asset approach, we're only concerned about two markets, right? Primarily the money market in which prices are fixed and the FX market. As we move from the asset approach to the monetary approach, we're no longer thinking about taking variables as a constant. Everything is subject to change. Everything is dynamic. So we must work with percent changes. In that sense, we can therefore think about an additional criteria to impose, namely the relative purchasing power parity, which captures the so-called real side of the economy. So combined with the asset approach, the FX market and the money market, we now have this PPP condition to impose and draw additional inferences about where the spot exchange rate should go far into the future. Empirically, relative PPP is more or less true, okay, satisfied, and it's mostly explained by Balassa Samuelson, okay, in their seminal paper. Of course, it can be invalidated in the short run, as I explained, if we think about comparing countries that have different productivity shocks. Yes? All right. Comments, questions on today's topic. So I will now just summarize the formulas that you probably should have in your head when you take the exam, but of course you should work through the intuition and explain to yourself at least why that must be true. Okay. So let's quickly summarize in the last 10 minutes. Okay, so what you learned in this lecture is what's called the Fisher effect, but it's slightly different from the Fisher effect that you learned in your macro class. So to summarize, to review a bit, in your macro class, you must have learned the Fisher effect, which decomposes the nominal interest rate into two parts, right? The real and the inflation. The international Fisher effect, which I presented in today's lecture, is slightly different, although it relies on the same formulas if you want to prove it that way, but you don't have to. Okay, so let me explain to you what's going on here. You have to assume relative PPP and you have to assume UIP to get this international Fisher effect. So let me show you the math. So what we want to show is the following. We want to show that the difference in interest rates must be equal to the difference in inflation rates between two countries. I already proved it once in the previous slides, right? But I'm going to show you again using the macro definition of the Fisher effect. So let's first decompose these nominal interest rates into those two parts, the real and the inflation part. And you can already see by rearranging the terms, all that's left is just r minus r star. So the inflation term is here. We want to find some way to get rid of this. Yes? So the first step, let's just take UIP to be true and express the real exchange rate in terms of its percent changes. Yes, so we get this equation here. And now we rearrange some terms. And you can see that the percent change in the real exchange rate must be equal to r minus pi and r star minus pi star. And we can, of course, replace these two terms, right, for the real interest rate. Yes? So far, what we've done is just apply the rule of changes and apply UIP, and you get this relationship, which you should know. This is the real interest rate parity, right? All right, second step is we impose the long-term condition, which just states that the change in real exchange rate should be equal to 0. Yes? We get this expression, and we also get this expression. Yes? Two things. So if we just use this, this is obvious. This tells us that this term must be equal to 0, which tells us that r minus r star is equal to 0, which means this is 0. We're done, right? What I showed you in the previous slides is that this expression is equal to this expression. You get the same conclusion. Right? So just two ways to prove it. One using just UIP plus the long-term condition. The other uses the decomposition of the regular Fisher effect, which you learned from your macro class. And you arrive at the same conclusion. Same assumptions. Okay, just so long as you can see the connection between the international Fisher effect with the regular Fisher effect. Yep. No. You do not have to derive anything in the exam. You will need to know how to use these equations, but you don't need to derive them. But it should be very simple, right? This is just applying the rule of changes and using the identities you saw in this lecture, right? All right, so let's summarize. So what did we learn today? We learned about 3 different forms of the law of one price. The first version of law of one price, you should all know, right? It's that identical goods across different countries must have the same price. Otherwise, there's arbitrage. But of course, arbitrage may not always be possible for various reasons. Market power, transportation costs, tariffs, whatever. So law of one price in its strictest form can be violated. So how do we relax that assumption? Well, even if there's violations in the strictest form of law of one price, at least maybe those violations could be averaged out if we look at baskets of goods and services. So this is what this expression looks like, right? Alpha is just the weight in your basket. Alpha I and alpha I is the same weights across across 2 countries for the same goods. We sum the weighted prices, right? That's just a weighted average. And we can realize that we can factor out the E. And so what we get for absolute PPP is capital P equal to capital E and P star. Yes? So that just says that our average prices is equal between 2 countries after exchange rate conversion, right? Currency conversion. Of course, this can also fail for obvious reasons. Just think about Japan versus US, or China versus US, or any non-Western country versus US. Completely different baskets of goods and services. And those prices will not necessarily, on average, be the same. Okay? So how do we address these differences? These violations, this violation can be addressed by relaxing the purchasing power parity even further, and just says that these differences in baskets of goods and services don't change over time. That just means that mathematically the real exchange rate is just a constant, or the change in Q is over time is equal to 0. And of course, this can fail, as I explained, right? There could be productivity shocks within the short term that can impact both P and E at the same time, right? P and E at the same time. All right, so the other takeaway is that the stronger form implies the weaker forms. Obvious, right? Take this equation, multiply by the weights, sum them up, you get P equals EP star. So even if law of one price holds, then absolute PPP holds. If absolute PPP holds, that's also obvious that relative PPP holds, because we can divide both sides by P and see that Q equals 1. 1 is a constant. So if absolute PPP is true, then relative PPP is also true. All right. The second thing we learn is the so-called long-term effect. Long-term condition. That just means that we're imposing relative PPP into our existing framework equations, and then thinking about dynamics as opposed to just fixed parity equilibrium equations. To derive the long-term condition, we simply apply the rule of changes onto the real exchange rate formula and impose relative PPP. That is setting the change in Q over time equal to 0. And then we get this following expression, which tells us inflation rate differences between country forecasts or predicts future changes in the spot exchange rate. And if we impose an additional assumption that UIP holds, we get the so-called Fisher effect, international Fisher effect. But what's important from this equation is that it implies that there is an additional monetary policy tool at hand to steer the direction in which the spot exchange rate can evolve over time. Right? You can change the speed at which money supply grows over time to impact how interest rate moves, as implied by the Fisher effect, and ultimately impact the exchange rate. All right, so these are the formulas you can see, right? You can see if you can change the speed at which MS changes, you change inflation. Fisher effect tells us that any change in inflation, all else equal, assuming money demand growth stays the same, our interest rates must also change. Remember, we're always forward-looking. Everything's dynamic. Everything's forward-looking. Based on this equation here, in which prices is allowed to reflect all changes in all other parameters, prices must jump, and the slope is more positive by this change in the speed at which money flows, which is delta pi. So the conclusion here is that now E traces P, and as long as you can influence inflation, you can impact E through change in prices. Okay? And this is different from a single permanent shift in MS, because we assume in these kind of models, at least in the very short run, inflation is basically 0. And we can see the difference in these two graphs, right? In this graph, it's just a one-shot case. Yes, one-shot case analysis of a single increase in the supply of money. Whereas if we're changing the speed, we're literally changing the height, multiple heights over time, right? These are mini increases. So the takeaway here is that in this case, prices will catch up to changes in money supply. Price will eventually catch up with the change in money supply. Whereas in this case, in which you're changing the speed at which money supply grows, prices are always chasing money supply. In that sense, you can impact the change in the spot exchange rate over time as well. So I'll let you read this over yourself. This is just to highlight the seemingly contradictory results you get, right? When you think about increasing money supply, interest rates should fall in the short term. But in the long run scenario, you get the opposite prediction. Interest rates actually move up when you increase the speed at which money supply changes, right? It's a very subtle distinction, but you should not confuse yourself, right? One is a single shot, and inflation stays zeros forever. The long-term scenario is you're increasing the speed forever, and that's going to drive interest rate actually upward because everything's forward-looking now. Everything is subject to change. So just be aware. Convince yourself that seemingly contradictory, but it's actually different. One is the single increase, and the other is actually the changing the speed at which money grows, and therefore impacting inflation, and therefore impacting the spot exchange rate E. All right, so I'll leave this to you if you need to understand the relationship between E and P and so forth. So this is not for, you don't need to know this for the exam, but if you want to know the calculus, this is the calculus. We need the calculus because we want to know the sensitivity of certain parameters with changes with others. That's all. That's why it's there. Okay, so I won't talk about this, but if you want to go over it yourself, by all means, it's here for you. All right. The last thing we talked about was why relative PPP fails. So we talked about imperfect competition, obvious, right? an example I'll give you is Cathay Pacific is the primary flight carrier airline in Hong Kong. You don't have a choice. They can set, to be honest, they can set prices whatever they want, and they can collude with the One World group all they want. Yes, tariffs and trade barriers, obvious reason why relative PPP. Just think about the Trump tariffs that they imposed on China, right? Trade barriers can have a short-run effect on prices if they translate to what customers pay. Transportation costs, obvious too. Fuel costs, insurance costs, storage costs can all be passed on to customers. But what's more interesting, however, is this non-tradable goods and productivity shock explanation by Balassa Samuelson, right? You can decompose prices into two parts, non-tradable goods sector and tradable goods sector. If countries become more productive in the tradable goods sector, their additional income could actually spill over into the non-tradable sector. That explains why price levels are relatively higher for developed countries over time. Yeah, so the key friction is that non-tradable goods cannot be arbitraged through imports, exports. Okay, so this is just more summaries of what we see in reality, explanation of the mechanisms. So our midterm will cover everything up to week 5. Okay, so hopefully you have the formulas at hand today, right? Yeah, I think you just have one additional formula, right, which is relative PPP, and then you can use that formula to derive everything literally covered in the past few weeks. All right, so that's all I have for you today. Yes, be prepared for the midterm. Happy to answer any questions. You have the full 3 hours to do it. So, and it's open book, open notes, just no computers. All right, good luck studying, and see you guys next week.